Gold, once a symbol of quiet wealth, is on the rise again. But this isn't the first time we've seen such a surge. Similar patterns emerged in the 1980s recession, 2007 and 2008 financial crisis, and most recently in 2024. Before we dive into the reasons behind gold's recent rally, it's important to lay the foundation by exploring two key points. First, how and when did this all begin? And second, what are the key factors influencing the rise and fall of gold prices? Understanding these will help you benefit from the next gold cycle. Let's start with history. To truly understand gold's rise, we need to go back to the era of the gold standard. Before 1971, every US dollar was backed by a fixed amount of gold. This meant that if you took your dollars to the bank, you could exchange them for gold at a fixed price of $35 USD per ounce. But in 1971, US President Richard Nixon made a critical decision. He decoupled the US dollar from gold.
I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
Effectively ending the gold standard. This marked the beginning of a new world order, where there was no limit to the amount of money the US and other central banks around the world could print. With the gold standard abandoned, inflation became a pressing issue. Governments could now print unlimited amounts of money without needing physical gold to back it up. As a result, investors turned to gold as a hedge against the devaluation of paper money. Even though governments abandoned the gold standard, people didn't. Gold became an even more pronounced store of value, and this was the beginning of its modern role as a safe haven asset. Two key factors drive the price of gold: fear and instability. To understand this, let's examine the major gold cycles we've seen since 1971. The first major gold cycle occurred between 1971 and 1980. During this time, gold prices skyrocketed from $35 to over $650 per ounce. Why? After the gold standard ended, the money supply exploded, causing inflation to soar from around 5% to near 14%. To combat this, the Federal Reserve, under Chair Paul Volcker, aggressively raised interest rates. This led to a severe recession from 1980 to 1982, during which one-third of savings and loan institutions went insolvent. As a result of that recession panic, gold prices surged during this period, but after the recession, they remained relatively flat to many people's surprises. It is noteworthy to notice that the gold price did not make gain for next 2 decades. During this period, economies were stable, and gold wasn't in the spotlight, with exception to the dot-com bubble in 2000, which was largely confined to the stock market. It wasn't until the global financial crisis when the gold started to shine again. After 80s, the next major gold cycle began with the onset of 2007 to 2008 global financial crisis. In the years leading up to the crisis, interest rates had been rising rapidly, spurring demand for gold. By 2011, gold prices peaked at a record close of around $1,150 US per ounce. After the 2007 and 8 global recession, gold prices stabilized between 2013 and 2019, trading in the range of $1,200 to $1,300 per ounce. But the story didn't end there. The third and current gold cycle began in year 2022 with rising interest rates. The global landscape shifted after COVID-19 pandemic. During this time, money supply went through the roof and production of raw material to the ground. Too much money was chasing too few goods. The result of that was high inflation. Hence, the central bank raised interest rates to rein rising inflation. And this rate hike was the fastest and most aggressive in modern finance. On top of this, the Russia-Ukraine war added fuel to the fire. This chaos led to a significant rise in the demand for gold as a hedge against inflation and instability. This period marked the beginning of an extended gold rally. Ongoing geopolitical tensions, trade wars, and the threat of deglobalization have further fueled the surge in gold prices. So what's driving gold prices higher now? The short answer: central banks. Before the Russia-Ukraine war, central banks were purchasing less than 500 tons of gold annually on average. Since 2022, that demand has more than doubled to over 1,000 tons per year. In addition to inflation and geopolitical tensions, another factor is now contributing to the gold rally: the threat of trade wars and deglobalization. It's hard to predict exactly where we're headed, but if history is any guide, the world may be entering a period of heightened competition between superpowers like the US and China. Let's recap what we've learned from these gold cycles. 1. Higher money supply leads to inflation. 2. High inflation triggers tight monetary policy, causing interest rates to climb. 3. Higher interest rates and inflation result in economic slowdowns, leading to fear and panic, which drives demand for gold. As we move forward, the interplay between central bank policies, geopolitical tensions, and economic uncertainty will continue to shape the future of gold. Whether you're an investor or simply curious, understanding these cycles can help you navigate the next phase of this precious metals journey. Gold has stood the test of time as a store of value, a hedge against uncertainty, and a symbol of wealth. Thanks for watching, and don't forget to like, share, and subscribe for more insights into the world of finance and economics.